Good evening, dear all investors. My name is Chandan Sinha. I am a Vice President of ALTPORT Experts. Today is a topic India's next wealth creations wave pre-crossover secondary strategy. I am welcoming Mr. Hitesh Ahuja, who has 19 years of experience in private equities and entrepreneurship. He is currently the co-founder and managing partner at Pixel XY Capital and the former vice president at New Silk Road P. He has made 17 investments with an average ticket size of $60 million. Thank you, Hitesh, sir, for accepting our invitations. And I request you to please share some valuable insight about the fund and the current market situation, sir. I vote you, sir.
Thank you. Thank you so much, Alport and Mr. Vikas Agarwal and team and Chandan, especially for having my colleague and me. My colleague is Shivi, also on the call, also on this invite, and myself, Hitesh. And we would love to take you through Pixel Sky Capital opportunity. Before I jump into the presentation, um we want to sort of tell you why doing alternate investment fund or AIF makes sense for a portfolio. Um, we believe there should be an allocation model to wealth versus which sort of picks up the best of all instruments available to investors. And we have seen thus far, at least in the recent 5 7 years, there has been enough and more allocation to listed equities and other instruments, although exist, but lack of awareness, lack of education, lack of knowledge, lack of understanding is one of the reasons most investors have not been able to sort of get exposure to them. Our view, our view is very clear that globally alternates are anywhere between 20 to 40% of investors' portfolio. That number in India is in the single digit range. With families and family offices, that number could be higher. It could be in double digit. But we can say that the HNI and ultra HNI and the mass affluent individuals and more and more as we see our country prospering don't have that much exposure in alternates. And alternates has a large gamut, which effectively takes into account the entire AIF business. The instruments could be like ours, private equity, which is buying into some specific themes, and I'll talk to you about that. Other instruments could be private debt or private credit, which have a, a different risk profile, a risk and reward profile. Other could be REITs, InvITs, and so on. So so we think every risk profile, risk reward metric is different. Today, I will explain you why our private equity AIF is one of the alternates for you to choose from as you build your portfolio and construct it. Coming to Pixel Sky, our strategy is unique. Our strategy is not existing in all the AIFs which you must have come across. We deep dived in the AIF industry before we came up with this strategy. We saw a very interesting trend in India, in Indian listed markets, uh, round about post COVID in 2021. We started to notice that more and more investors you know uh, have gotten exposure to small cap, mid cap, large cap, flexi cap, and so on and so forth. There is a interesting theme which is emerging, where we saw an opportunity for investors to get exposure to what we call our new age technology companies, right? What does that mean, everybody? What it means is that there used to be companies in the logistics space or the trucking space or any of that. But now in the last 10-15 years, with whatever, whatever progress India has seen, there has been a big tech lever or technology lever. So application or app businesses have made the same logistics businesses better, faster, more profitable. So logistics tech becomes the tech or the new age business. So a same trucking company is available on public markets, but a logistic tech is a new age company. That's what we mean by new age. Similarly, manufacturing tech, beauty tech, fintech, and so on and so forth, travel tech have emerged. So what India saw post COVID, very most famously Eternal or Zomato as one of the successes in the food tech, now quick commerce tech, has now mushroomed to 50 companies in the last 5 years. So there are 50 listed companies. Everybody, that market cap is round about 10 lakh crore or $100 billion or thereabouts, right? That number used to be non-existent about 5 years ago. We think that market cap will grow 10x from here, right, in the next 5-10 years. It could be 2031, it could be 2034. But we think that market cap will become from 10 lakh crore or 100 billion to about $1 trillion or 100 lakh crore, right? So that's the opportunity. We think that opportunity does not exist beyond the 50 names. We think there is a large base of companies which are like these 50 technology digital companies in new age sector, and we believe that number could be 200 to 50, and we want to build a portfolio and tap into and access those companies. Now what that does is, for an investor like you are basically getting a future Reliance and a future HDFC and a future Bharti Airtel into your portfolio with a small check, could be varying between 1 to 10 crores depending upon your risk appetite, right? Now you build a portfolio of these new age companies. Could be, in our fund is going to be 8 new age companies, and that becomes your way of playing the new India which is emerging. This opportunity of $1 trillion GDP. I'll give you some examples of why I say this is exciting. There is a market you probably are familiar with, Nasdaq in the US, which is a technology market in US, and big names like Google, Nvidia, etc., are part of that market. There is a similar market in China, which is called Hang Seng Tech, HSI Tech, which has got the Alibaba, Tencent, etc. Right? We have a similar story here. So what we are thinking of and what we are seeing happen is similar to what's happened in US, China, and now happening in India. So that's really why we believe this AIF is a unique AIF for the tomorrow of India, and where there will be an interesting intersection between technology, the young population, demographics, and so on. And this fund got created as Pixel Sky Fund to tap into that opportunity. That's the opening, Chandan. We could dive into the presentation and take everyone through it for the next 20 minutes or so, and open it up for questions if that is. So everyone, this is called Pixel Sky Secondaries Fund. What we do is different. What we tap into is all companies which are profitable, late stage, very near to liquidity. We call it, liquidity could be usually IPO. And we go and buy stock from some of the investors who have been in the company long enough. They could be venture capital who've been with the company. They could be angel investors who backed the company when the company began, or they could be some CXOs or employees who are part of the journey as they're building, and we provide liquidity or we give them some cash outs. So effectively, this is a fund dedicated for winner companies, which are 3 to 4 years from IPO in the new age and consumer space. And how we go about is we go and tap into these old investors who have who sit on book profits and are looking to sort of make some liquidation or get some profits out. So this is a unique fund in India which taps into this opportunity. Yeah. What normally we tend to be very clear that in pre-IPO we are very clear about one messaging, and this is one thing which I want to clearly tell the audience here, that we are not chasing pre-IPO companies. And the definition of pre-IPO is anything which has DRHP filed, prices discovered, the company is now coming to the domestic institutions and retailers to build this. So we're not tapping into that because we think the story is already sort of called out. There is enough and more. There's a 300-page document or a DRHP. So we tend to be sort of clear about being one step before pre-IPO, and hence our holding periods are about 3 to 5 years. Typically, pre-IPO opportunities are less than 24 months, less than 18 months, sometimes less than 12 months. And hence our risk reward changes because we are 3 to 5 years, and our returns are commensurate of that. We'll talk about that in a bit. But our fund is not a pre-IPO fund. Investors coming in should know that we typically would have a 3 to 5 year hold period on our investments, and hence we call ourselves pre-crossover. One question has emerged from Sailesh. Which sectors we target? And I'm just going to continue doing this so it's interactive because otherwise I can keep going on with slides. We target sectors, Sailesh, primarily all the subsectors. If you don't mind, should we just jump to that slide in that question Sailesh has posted for everyone's benefit? Just go down the fund slide. Yeah. So Sailesh, we target all these sectors we've named here. We could look at we've done some deals which we'll talk about, but they could be different. They could be internet marketplaces. Either they are vertical marketplaces like the ones we've done. Example of vertical marketplace is a Lenskart, and a horizontal marketplace is an e-commerce company like a Meesho. That's the example. The fintech opportunities, fintech, financial services, consumer brands, enterprise tech, SaaS, and so on. So that's a broad range of sectors which we target, Sailesh. Yeah, so we can go back to the sequence. So why we are doing this AIF, everyone? We are doing this AIF because we see there has been a lot of AIFs in the past 15 years who have done a lot of investments into these companies. Now these companies have grown. These funds are now approaching 8-10 years of lifetime, and we think it's a good time to sort of tap into these companies, and hence this AIF. We also see the market opportunity is large. There are about there are close to the 50% of money is still to get out from the old funds, and we chose this opportunity hence. The market for that, we've done some math. We think we could buy the early investors, including employees, angels, VCs, etc. And that math works out to a pretty large number, almost $70-80 billion. Some of that stock will be coming to secondaries. Not all will come to secondaries, which in itself is a pretty large number of $20 billion. So that's really why this AIF is of interest to us and should be of interest to you. Sure. I'll come to that answer, Sailesh, which you've asked. If you don't mind, I'll just come to that slide in a second. This is also a global trend, gentlemen and women. This is an interesting trend on this. I mean, globally, they don't have an AIF model, but globally, the models for some of these big names are also tapping into some of the old primary funds who have done investing and are now needing liquidity. So it's a global trend which we are following. Yeah. The model here, we saw a gap, and I covered it in many ways. But most Indian HNI base or clients haven't seen AIF in the late stage category. They've seen in the early stage and the middle stage category. So here we give you a flavor of super late, which usually won't be coming in an AIF format and in a small fund format like us. So hence we thought of sort of showing you in this slide that you're getting a AIF in the late stage format, which is established companies and a gap with capital which you can deploy between 1 and 10 crores. Yeah, so that's really it. I talked about this earlier, the opportunity of Indian tech and the comparison to US and China, right? And this is really what that slide is about. Um, uh, I'll answer this question also. Please keep posting in the group. It's probably uh, better to just answer at one go once I've completed to complete the flow. I'll maximum take 10 minutes more, everyone. This is what we see when we made this slide, everyone. We want to show you how India has progressed. With 15 years ago, not too long ago, there were only two listed companies. One listed on Nasdaq called Make My Trip, another listed on the NSE called InfoEdge. That fast forward today has become 50 companies, 10 lakh crores. That fast forward 5 to 8 years out will be 1 trillion, 200 companies, 150 companies thereabouts. So that's really why we wanted to do this. And this is the sum and substance. This is why we see these three bubbles are of interest to us and to you as well. Yeah. Like I talked about the fund, we will do companies which feed into the Indian story, which includes consumption, which includes you know exports, software exports, which includes financial services, which includes some app-based businesses, etc. Yeah, this framework is unique to us. It's a framework we have designed. We call it you know uh, the framework of 6 steps, which includes team, right to win, profitability, growth, the listing intent, and a return threshold. What that does is that this is how we stick to our investing, because you know we can see many unlisted companies. There are about 2 lakh plus startups which are registered with DPI DPIIT, right? So we tend to sort of stick to framework of to come up with our portfolio, and that effectively means the team. We need to know the company, the team, the right to win, profitability and the revenue potential, intent to list, as well as a target of a target of 3 times money or 25% return. We designed this framework and we decided we will go and look for hunt for companies. We believe there are about 300 to 400 companies in our framework. We think we will execute 8 such companies as a part of our portfolio, ranging between 30 to 50 crores, and only companies which have valuations in the unlisted market upwards of 1,000 crores and are exitable in 5 years. So I'll keep revisiting this framework during this discussion. So just wanted to tell you that this is really our portfolio construction thought. Yeah. We did this first investment team. We've done this investment in the beauty tech company. Most of you may be familiar with a listed beauty company called Purple. We have invested in a company with Nike. I'm sorry, we've invested in a company which is unlisted. Like one would say it's a tier 2 and tier 3 market focus story, not a city and an urban model like Nike is. This is called Purple. Purple is a phenomenal company. It's gone on to become a 2,000 crore, 1,900 revenue, approximately thereabouts, in a revenue base or a net sales value. It's near about profitability, and we liked this company. We knew this company since it was a 100 CR business in last 7 years, 8 years, and We saw the investor base. We knew we're getting an opportunity to buy through one of the avenues I talked about, and we went in this company 18 months ago, and from then, FY24 numbers were, only 1,200 crores. It's gone on to become 1,900 crores. So it's given us that 25-30% growth we seek. It's gone on to become from a negative EBITDA company to a near break-even company. And we think this story is just building. So what we did 18 months ago is working is coming to fruition. We are in the middle of that zone, and also the price we entered has gone up since then. So we are still in this fund carrying this company at cost, and the advantage will be given to investors in our fund to come in at the same price we came in as the fund, until until the next month or two at max, or thereabouts, until our fund closes. So we think this is a 30-35% return story, or a 3 to 4x return story from our investment. That's really the first investment called Purple. The second investment is, the first one was beauty tech. The second is what we call logistics tech. You're familiar with trucking companies, like I gave you an example. This is an app business which is serving within the city of within the same city, or what we call intra-city network. And this company has grown phenomenally. It's doubling. I mean, it's adding revenues at a very brisk pace. We've seen this company from a very long time. We were fortunately able to get a piece of it in almost a year ago, and we invested about 40-45 crores at a valuation which was at a valuation which was then about 2.2, 3.3 times sales. The company has grown 50% since then, so the valuation is less than 2 times, and the appreciation in stock is also going to happen eventually, because our investment is only a year old. We think this story is also emerging equally strong or stronger in our fund, and again, this is being carried at cost. We think this company is grown 60-70% since our price we entered at, and this is a unique company. When we say unique, it's got a monopolistic position in the space it's operating. There is really no number two we can speak of, and hence Porter is a very interesting company. Many large firms, families, etc., have tried to access, but the company is very clear it wants to institutionally build itself. So we have this access, and this is a part of our portfolio. So that basically completes our two portfolio companies. Both have performed well, and both are carrying at cost. One in beauty tech, one in logistics. We made a third investment as we speak. We are in the process of closing in this month. The third investment is in the space. Shibi, if you can just go to the next slide. The third investment is in this pipeline which we are sharing with you. Once we announce our third investment, we will have a similar slide, which like Purple and the other one. And this is beyond the third investment. We are looking at some of these late stage companies which meet our criteria of 3 to 5 years of listing. Once again, you may know some names, you may not know some names. Since we are showing some names which, since in our slides, which in the last 6-9 months, they've already gone public. One example is WakeFit, it's gone public. Another is Sedemac, which has also gone public. So what I'm trying to say is that, our assessment of that opportunity of going after those 150-200 names and $1 trillion opportunity, we sort of did a pipeline of which even we are seeing these companies go public, and that's really the pipeline for you. We will select 5 more companies. We'll expand the pipeline beyond these, and select 5 more companies, because 2 are done, third is getting done, and 5 more companies, and we will do the investments in the next 12 months, 9 to 12 months, thereabouts. Yeah. This is about the fund's ownership, the fund's parentage. This is interesting. why are we the right people to partner with? Why are we the right people to consider as an AIF? I think what we bring to the table is something unique as an AIF. We have a history of running a investment bank. What we've been doing, we've been running a technology investment bank by the name of Indigo Edge. Indigo Edge has a 20-year history of operating in investment banking business, and in the last 8-10 years, they've effectively done a great deal of work in the technology investment banking. So most of these app-based companies needed growth funds, and Indigo Edge has sort of worked with some of these names which we have talked about in that process. So just to give you some understanding of the scale, we've done 100 now, I think 150 plus transactions. We've done close to 25,000 plus crores or $3 billion or thereabouts of capital raises. Oh, in that time, we were the first players to help Swiggy, which is now a very large company. It's public, to help raise their rounds. We were also, Purple, which is part of our portfolio now. We've helped them raise. Similarly, many more names. That's really our history. We are headquartered in Bangalore, and Indigo Edge decided to sort of branch out and do a fund management business. And I have my background will be visible in a bit, but Indigo Edge and I decided that we should go to the market with a unique opportunity and came up with a fund. This particularly provides the access of ours. Why we think we have an advantage? Because we have a very unique deal flow which we get from our system, and we are able to sort of filter the deal flow which we think could be of interesting for the fund business, as well as we have an ability to create an exit because we run a banking shop. We can create an exit in the private market should we need to. So that's really an ability to do that, and Indigo Edge is strategically backing this fund. That's the parentage. Yeah. So this is just beyond the name Indigo Edge. This is one of the founders whose background is displayed. They've been running a treasury book within the Indigo Edge system, of which the track record is 25-30% IRR. And some of the deals in the advisory business are listed. I have a background which is into fund management. I have actually as a vice president, I've ran $1 billion plus fund. I must admit that I was part of the investment team. I wasn't the CEO of the fund, but I was part of a large fund. So that 6-year history of investing $1 billion exists. Some of the investments include VRL Logistics, which is now a public company, Destimony, which is a parent company to PNB Housing Finance, which is also public, Rolex Rings, also public, Sri Chaitanya, you must be seeing a lot of that. They are in the prep space, test prep space, a pretty large name in the Hyderabad. So that's my background of investing, as well as I've been an entrepreneur and I built a business from scratch, sold it to a food tech business 3 years ago. So I bring that expertise of investing and entrepreneurship along with Indigo Edge, and we sort of partnered to do this as a team. The product, and before I leave the floor open and start answering questions, the product is very unique. It's a fund of 400 crore size, a 400 crore category 2 AIF. It's a short tenure fund. Of course, AIFs, in the AIF realm, it's a short tenure. Usually AIFs are 8 years, 10 years, 12 years, and thereabouts. So from that lens, we are only about 6 years. We've completed 1 year of execution from our first from incorporation. We've completed more than 1.5 years, but from our first close, we've completed a year. So the fund life has another 5 years left. We've got last year and this year, which is what we call 24 months to invest this capital. And of the funds, 400 crore, we are right now last 40-50 crore or thereabouts, which is where we are raising this from all of you. And our minimum ticket as per the AIF rules is 1 CR. We take 57% drawdown And for that drawdown, we intend to do 4 companies, of which 2 are done, third is on closure, one more, and the balance 43% will be drawn down from investors over the next 12 months. I mean, we've written timelines of September end and December end. If we see promising deals, we'll draw down by then, or we may choose to draw down a quarter later. And that's really the drawdown schedule. And we will start distributing capital as and when we exit. So this is an interesting way to approach it. So most of these companies we are investing in are all IPO, working towards IPO 3-4 years out. So we will give you capital back over the next starting 28 or 29, whenever the first company lists. Our fee structure is very standard in a category two model. We take 2% management fee. We take a performance fee of 20%, and for that we have a hurdle or a return rate of 12% as a starting point before the performance rate kicks in, and a 25% IRR. Our focus is, we think, to operate in that 25% IRR bracket, we need to take 3 to 4 years from IPO story calls. That's really where I'll pause here. I'll jump straight into the questions my friends have asked here. Just a second. Just a
Yeah.
second. The Q&A. Yeah, I think the question from Sailesh, the second question which Sailesh has posted, can you advise what is the CAGR sales and CAGR earning growth in these companies and his exit 7-year period? CAGRs is usually, the revenue CAGR is usually 20-25%. EBITDA and PAT CAGR is obviously higher, would be 40-45 or thereabouts. We tend to have a 3 to 5 year hold period, Sailesh. So exit is usually between 3 to 5 years from our investment period. How much of your own personal net worth is invested? We have invested, Anmol, we have invested out of 400 crores, close to 4% in the fund. That is way above what our minimum investment guideline is. Beyond standard research, what proprietary data engine or unique sourcing channel gives your AMC? I talked about our parentage, Anmol. That's our unique selling prop. And that's really why our AMC is able to access such high quality names. Mind you, there are lots of unlisted names. And for investors who are playing unlisted, except for NSE, it is debatable what really is working. And NSE is also a very unique asset. I mean, India won't get unlisted NSE type deals all the time. And had it not been a unlisted company for a very long time, not many people would be able to do 10 lakh, 15 lakh, 20 lakh checks. It's one of the rare opportunities as investors you should recognize. So unlisted on a deal by deal model, which most HNIs tend to do, is one way to play it. But we would urge them to create a portfolio and work with a manager. Why so? Because it gives them a diversification. It gives them a extra bit of knowledge, as Anmol has said, what research, etc. And then there are basic unlisted, like right now SBI AMC is getting public, so that we don't operate there because we think there is no edge to make real 25% alpha. You can probably double your money in 3 months, 6 months, all that stuff. Nowadays, doubling is also very tough, as you would agree. In fact, capital erosion is a risk rather than doubling. So we tend to sort of be more patient. We think real value is not created in instant gratification mode. We think we take that time. So that's really so if you have patience, if you believe you want to play a long game of 3-5 years, is where you should be in our AIF. We are giving a 12% hurdle. This is Lalit's question. Are you giving a short? So the way the AIF model works, Lalit, is we have a hurdle rate which is 12%, which over a 6-year period doubles your money. So if you put 1 rupee, hurdle rate of 12%, 6 years, about 1.97x, right? So what that does is that we are not saying that it will hit 12%, but we don't have any incentives as managers to carry any fee in the profit fee or performance fee if we don't hit hurdle. So A, we're not giving you assured returns of 12%, but B, we are working with, at the end of the day, we are also working as managers to, create performance for you and end performance for us, right? So our interest is to hit in that 2025 region mark, right? And 12% is anyway something for table stakes. We don't really think about it. Think of it, the companies we are entering are themselves, growing at 20-25%, right? So we don't want to assure any return because we're not a debt AIF or a private credit AIF or any of that. We are a private equity AIF. But that's really the answer. So we would be not saying that, we would not say a short return, but we have to call out a hurdle if we are taking a performance fee. Yeah.
Yeah, thank you, sir. Dear investor, if you need any doubt, clear your doubts, so please ask on chat box, sir. If you need to directly talk with him, just raise your hand. I will allow to unmute yourself. Please ask other questions. I think so. Everyone get the answer. So, can I conclude the call, sir?
Sure, Cheta. Sure, Chandan. Thank you so much. And thank you everyone for coming on the call.
Yeah, thank you, sir. Thank you all of joining us today. We hope these sessions added value to your work. Yeah, thank you, sir. Thank you, Hitesh sir and Sidvi. Yeah,
Thank you
Thank you,
again.
Chandan.
And we look forward to, yeah, somebody is
One second.
asking, are you
Sanjeev
there?
is asking something. He's saying, "Are you there?" Just one second.
Yes, we
Let me
are.
allow him. Let me allow him to unmute.
you just met.
Are you listening?
Sanjeev sir. Yeah,
Are you listening?
yeah. You can ask, sir.
Yeah. My point is that what will be the advantage of putting money into your AIF rather than the other funds which we have already invested in the market? You have specifically mentioned about your, as what you have described, like the companies which are booming up with 30 to 35%. But just wanted to clarify the thing that whether it will be acceptable at 20% minimum side. That's what I want.
Sorry, Mr. Sanjeev. Your question is, what will be acceptable minimum 20?
Yes, that's what.
Sorry, could you repeat your one, like that same question again, if you don't mind?
No, you were telling about the companies where you are going to invest. It is like 30 to 35%. But my question is, if I am getting 20% also, that would be much okay for me. But can you have some sort of guarantee that 20% will be achievable? That's what.
So look, equity business versus other. So I mean, you the answer is, I wish I could give you the assurance, but I think why you invest in a fund is exactly why, because for this reason is because when you build a portfolio, and our portfolio is all late stage companies. Some years they'll grow at 25, some years they'll grow higher, some years they'll grow lower. So we operate with that dynamic that it has to be an all weather portfolio, Mr. Sanjeev. It's just that we don't want to be in a zone where we say we will give you 30 and we end up giving you 15. We are working very hard to generate these kind of returns and go for these companies and convince them to take our bring us on their cap table. So the hurdle rate should give you some assurance of 12%. Will you get excited at 12? May not be, but will you Will you be able to see our performance in 2, 3 investments and believe that we can generate you upwards of 20? We leave that assessment to you. Can we deliver that? We think we have because we have a 3 to 5 years time, we have a reasonable chance of delivering that.
Thank you so much. Just wanted to clarify that only. Right. Thank you.
No, not at all, sir.
Yeah, thank you, Sir Sanjeev sir. I think so. We can conclude the call. Thank you,
Thank you,
Hitesh.
Chandan, for all your for taking the effort to organize this, and we
Yeah,
really appreciate all the questions from some of you. And any more questions, we are available to answer.
yeah, yeah,
Appreciate your interest.
yeah.
Bye bye.
Thank you, sir. Thank you, sir.